Hello, everyone, and welcome to the PropertyInvesting.com investor update. It's actually the first time I've done one of these in a little while, so I'm blowing out some cobwebs. Thank you for those of you who were able to join me live and a special shout out hello to you if you're watching the recording of this webinar. I'm sorry you couldn't join me live, but it's great to have you on board anyway. If you haven't been to one of these events before, never fear, you are in safe hands. The way this works is that I run through a presentation and later on I'll answer any questions you've got. And it's pretty easy. Just sit back and listen. But the real gold in these webinars is not just listening, it's writing down the things that you think about as we run through the webinar, because they're the things you want to action. You're probably going to forget most of what I say within 7 days of me saying it, but if you've got things written down, little notes along the way, things that prompt you to take action to improve things, then you will get value out of the webinar, at least 3 times what you paid to be here. What is a webinar? A webinar is simply an online seminar, a seminar delivered on the web, hence webinar. Most people are familiar with that concept now. There is a slide deck that goes with this presentation, which is a copy of the more important slides that I'll show you tonight. And that way you won't be sitting there trying to take down everything that I say, because you've already got a record of it and you will be focused on those prompts that I mentioned before. If you do have questions, it is only me here tonight. Everyone else has decided that there's a better option. So I won't be able to necessarily answer your questions as we go along, but we will have a dedicated Q&A period later. And of course, we're doing a recording, so if you have to jump off early or you jump in late, not that you'll hear this if you jump in late, but anyway, you'll be able to access a recording. Just takes a couple of days for me to do my magic and to get the recording going and then upload it somewhere, and then I will send you out a link where you can watch the recording if you want. That's the preliminaries over. What exactly are we going to be talking tonight? Well, how do you go about investing in unpredictable markets? We'll cover some real life case studies of some properties that I've been buying lately. Have we sunk or have we soared? About a year ago, we launched a new fund, the Strategic Opportunities Growth and Income Fund. And now we're a year in, we've got some show and tell. What's gone well, what hasn't gone well, what's likely to happen in the future, all going to plan. We'll do a Q&A period. And then if you can hang around to the end, you're going to see what my predictions are for 2025, which is pretty exciting. All right, I don't know about you, but I want to say ready, set, go. For those of you who've never come across me before, or you got a link to this webinar and someone said you need to jump on and listen to it, let me give you the Steve story really quickly. I, once upon a time, was someone who was really unhappy at work, thoroughly miserable doing accounting, back when I had a bit more hair. And my health was starting to suffer because I didn't want to do accounting and I felt kind of stuck doing it. And the idea of having to work 40 years doing something I didn't like doing wasn't very appealing. And so in about 1998, as my wife and I got married, I started thinking there must be some other way to make money. And so I went on a bit of a crusade to look at the various different ways you could make money. If it was a get-rich-quick scheme, I probably looked at it. And in 1999, after reading Rich Dad, Poor Dad by Robert Kiyosaki and attending his seminar, I stumbled across this concept of positive cash flow property. I didn't know what it was. I knew what negative gearing was because of my accounting days and advising people about negatively geared properties as a tax deferral strategy, but positive gearing, I didn't know what it was. Put simply, positive gearing is the strategy where you buy real estate and its income's greater than its expenses, so it puts money in your bank account. And then in my case, I went and bought enough property that was positive cash flow to not have to do accounting anymore. And hence that was the story of my first book, From Naught to 130 Properties in 3.5 years. That's all good. That came out, I'm showing my age here, that actually came out 21 years ago. Can you believe it? 21 years ago, that first book came out. And of course, there's been 21 years of life since then. After no longer having to work in accounting, I still stayed involved with real estate. I've been doing this now for quarter of a century. And I ended up in the United States of America buying a couple of hundred properties. And that went well. And then I believe that the next thing that was going to start going up in value, much like we're sitting here today, trying to figure out what's going to happen in the future, trying to predict the future. In about 2009, I was in the United States trying to predict the future, and I thought commercial property, Australian dollar is getting up. Let's start a fund and go and buy commercial property. And that's what we did in 2012. We started the Passive Income USA Commercial Property, and I put an offer out to the database and said, look, I don't really want a job, but I so believe in this opportunity that if you want to put your money with my money, we'll go out and we'll buy commercial property in the United States that's positive cash flow, growth story, and as the dollar comes down, we should make some money. And that's exactly what happened. In fact, we frankly shot the lights out. The fund did so much better than I thought it was going to do. Annualized for the period that the fund was active, we did over 16% per annum after fees. In fact, the return's even higher than that because people got foreign tax credits to use to offset their tax. So that investment was a high five smash hit. Then, once we started wrapping up the US fund, people started saying, Steve, we don't want our money back. This thing's done so well. The strategy worked. What have you got for us coming up? And I said, you don't understand. I don't want a job. I got into real estate because I don't want to do accounting. Certainly don't want to be a career fund manager. And people are like, but Steve, we don't know who to trust. We don't know who else is sort of in real estate who seems to be able to do what you're doing. And around the same time, a fellow director in the US fund and a longtime mate of mine, Paul Harper, came to me and said, Steve, or he calls me Macca, I'll do the compliance and the reporting. You just concentrate on finding and buying good property deals. And I was like, you know what, I can probably do that. That sounds like fun, a lot more fun than compliance and reporting. So approximately a year ago, we launched the Strategic Opportunities Growth and Income Fund, and here we are today. Right, so there's a little bit of background to me. I've bought hundreds and hundreds of properties. I've bought hundreds of millions of dollars worth of property. I've sold hundreds of millions of dollars worth of property. I'm not sure there's anything in the last 25 years in real estate I haven't seen or done, and it's been quite the journey. Other people have come and gone. Somehow or other, I've stood the test of time. And what my passion is, what I get excited about, is helping people who don't know how to invest strategically and profitably. And hence, that's the real excitement I've got with this new fund that I set up. You can, like we did in the US fund, you can invest with me. We pool our money together and we buy what we call strategic assets, which I'll talk a little bit more later on. But the first topic that we're going to talk about tonight is how to invest in unpredictable times, which we're sort of at the dawn of entering right now if we're not already in that time. Now, the first thing I'd say is this. We all crave certainty. We all want the sure thing investment. We all want the return without the risk. We all want the upside, but we don't want the downside. And unfortunately, in times of uncertainty and when things are less predictable or more unstable, these times are traditionally excellent times to invest, but they require a certain level of fortitude, confidence, and skill that the average person doesn't have. So what do they do in times of uncertainty where we crave certainty, but we don't have it? Well, the first thing people often do is they withdraw. They go, oh, things are getting scary. And they go, I don't know what to do. So they end up doing nothing, which of course is a giant mistake because you can't win the game of basketball shooting the final shot on the sub bench. You got to be in the market to profit from the market. And I can tell you that in the next week, in the next month, in the next quarter, in the next year, there will be the property deal of a lifetime that gets transacted, regardless of whether Trump is having a good day or a bad day. And if we withdraw and we go, oh, we become protectionist and we concentrate on preservation, mindful of presentation, but concentrate on preservation, we close ourselves off to the opportunity. And therefore, we underperform. And our job is not to perform. As I say later, our job's always, as investors, you and I, most money, quickest time, least risk, lowest aggravation. And that means that in unpredictable times, as we'll go about talking about in a second, things do change, but we adapt and change with it rather than just going, oh, it's getting a bit scary. Another thing that people do in uncertain times is that they try and listen to other people a bit more. They try and tell me where I should be investing. They lack the confidence themselves, so they try and plug into another source. Now, that's fine unless the other source has this giant vested interest in telling you stuff to get you to buy stuff which isn't necessarily right, i.e., you should buy in suburb whatever. What's the ulterior motive? Because often these days you have these buyer's agents who get paid commission when you buy, but they have no dog in the fight. They've got no skin in the game. So they tell you about what to buy, and then it's all care, no responsibility. You've got to do the due diligence, and you wear the consequences if the investment is a dud. And I come across people on a pretty regular occurrence where they come to me and they go, I've bought this property, it's a dud. Unfortunately, one email this week alone, someone said that they had lost hundreds of thousands of dollars by getting into a bad investment. Easy to do. And then lastly, there are sort of other experts that people sort of gravitate to. I might be one of them, in fact. They go, what do you reckon's going to happen? So what I would say is that if you turn to someone, don't turn to someone who has no idea what they're talking about, i.e. a well-meaning friend or family member. Everyone's got an opinion, and most of them are like farts. Frankly, they stink. But if you can find someone who has no vested interest, has the experience and the runs on the board to be able to invest through the uncertain times, that's the person you've got to try and find. Don't necessarily come to me because I'm doing less of the sort of market updates and that kind of thing because I spend more time making money for people in my fund. And myself, of course, because I'm the fund's largest investor. So, with that in mind, here's some helpful hints from me, right? And a lot of what I'm going to be talking to you about tonight comes from a professional investor's perspective. So you're probably not going to hear it anywhere else, which might be refreshing. A little bit scary. Sometimes the concepts might be a little over your head, which means you might have to watch the recording, but what do we need in these times of uncertainty, in these times of unpredictability? The first thing is we need a proper perspective. However bad it gets, it too will pass. And all we need to do is ask ourselves, do we wish we had have done more investing 5, 10, 15, 20 years ago, 1 year ago, 2 years ago? And of course, if we sit here and we look in hindsight, we're like, well, yeah, I wish I had have bought more property in 1999 or 2004 or 2010 or 2015, even in the depths of COVID. So what do? We forget about all the noise that was going on. Remember COVID, the world was going to end, we're all going to die. And it's hard to be positive in the midst of gloom, right? As it was once said to me, if it's a fog up here, it's a mist out there. You can't see clearly, right? So we need to pull back from the noise and the hype and the headlines about Trump and inflation and interest rates and everything and just have a proper perspective. We need to ask ourselves the critical question. It's not on the slides. You better write it down. Where's the opportunity? Because if we're not focused on the opportunity, we're probably going to be focused on the bad news story, which is going to cause us to withdraw. We need fortitude. We need some ability to rise above the negativity that we might be feeling because the uncertainty causes doubt. We need a strategy. So instead of just trying to do anything, we're actually trying to do something, because when we've got a strategy, we've got a basis for being able to say, does this actually meet the strategy or not? Does buying this property, does buying this asset move me closer to or further away from my goal? Oh, I don't have a goal. Well, then how do you know what's the right thing to do? How can you possibly know? You must just be running around trying to buy what you think and hope is a good asset. Then we talk about skill. Now, there's a lot of dumb investors out there in the market running around trying to buy good assets, and they think buying a good asset is going to overcome their dumb investing. But history tells me that's rarely the case. Now, you can be a dumb investor with a good manager, but you can't be a dumb investor with a bad manager. If you're a dumb investor with a bad manager, that is not going to end well for you financially. So what we want to try and do as investors is identify the opportunity. Remember what I said before, have the skill to be able to work out whether it's a deal or a dud, and then find a smart manager of our money. Because we want to hold the manager accountable. If you end up being the manager of your money full time, you've just got another job. Yes, you need to keep an eye on the manager, hold them accountable, but if you ever hope to be financially free, then you don't want to become a full-time manager of your money. You want to become an astute part-time manager of your money so you can enjoy your time doing other things. Now, I've put together a little diagram for you to kind of illustrate what happens in times of uncertainty. So the first thing is we've got asset return, and hopefully it's like a spectrum where you've got different assets at different returns, higher returns to the right, lower returns to the left, right? Nothing revolutionary there. And the very first thing we need to do is, I found an asset that earns 4%. Is that a good asset? Well, on a return basis alone, what we do is we compare it against the risk-free return. Let's say you could get 5% in a term deposit. Well, why would you invest in an asset at 4% when you can get 5% risk-free? So we end up with two zones, what I call the no deal zone and the deal zone. The no deal zone is any deal where its likely return is lower than the risk-free rate because you're taking a risk and not getting paid for it if you buy that asset. That is speculation. The deal zone is where the asset return is greater than the risk-free rate. Hence it's green. But things are a little bit more complicated than that than in investing land. When you buy an asset like a share or a piece of real estate or, God forbid, crypto or something like that, you're not buying a risk-free asset. You're not buying a government bond. You're not buying a term deposit under 250 grand. You're buying a risk asset. So the dashed line presents to you the margin above the risk-free return for that asset class. Commercial real estate, for instance, usually, in my opinion, sits at about 4% above the risk-free rate. And now we redraw these zones, and the no deal zone increases and the deal zone decreases. And this is the pricing of assets that I have learnt to do over 25 years that other people have no clue about how to do it. They just focus on the asset and wonder, is it a good asset? They look with their eyes, they don't see with their brain. And so they think, they make the classic mistake that a good property in a good area with a good tenant must be a good investment. As you'll see tonight with some case studies that I'll show you later on, that's not necessarily the case. Okay, so now we try and apply this to times where things are unpredictable. And when things are unpredictable, there's an increase in uncertainty, which must therefore mean there's an increase in risk. Now work with me on this. If there's an increase in risk, what must there also be? Anyone? If the risk goes up, what happens to the... Anyone? Everyone's gone to sleep. Hello? Yes, your return must also increase. So what happens if your risk goes up because things become unpredictable, but your return stays the same or worse, goes down? Well, you're in a world of pain because now you're taking risk and not getting paid for it, so you haven't priced your risk correctly. That was the trigger for us to sell down the US fund when the risk went up, but the return stayed the same or went down. It was time to redeploy the asset or the money into other assets. So our required, try saying that, risk price return goes up when things are unpredictable or unstable. And if you haven't got around to waking up and going, yep, things are a bit scary now than they were 6 months ago because of geopolitical or Trump or whatever else, and you still pricing your assets the same way, then you're kind of not doing it right, is what I'm going to say. You probably don't know what else to do, which is understandable, but the principle here is that as risk goes up, return must also go up, because you never want to take a risk without being adequately compensated for it. So, stopping for a moment and looking ahead into 2025, which is next year, do we think there will be more or less unpredictability? Yeah, I mean, I think next year things will be even less predictable than they are now. I think we throw in a variable like Donald Trump, we throw in tariffs, we don't know what's going to happen in China, Ukraine, Russia, blah, blah, blah. I'm anticipating next year is going to be a harder investing climate than this year. Right, so if we think unpredictability is going to go up, which we do, or I do, for what it's worth, then we need to either, in response, decrease the risk, right, to compensate. What can we do to decrease risk? Or we have to increase the return. So how do we decrease risk? Yeah, okay, great. Here are 6 de-risking strategies for you to think about. The first is to, don't just invest anywhere, look to invest in areas where demographics align positively with momentum. Let me give you an area where it is, and let me give you an area where it isn't. Coming into the Olympics, the amount of spend that has to happen in Queensland, and in particular Brisbane, is going to bring forward a lot of consumption and focus it in the next few years. Contrast that with Victoria, where things are ordinary, without wanting to say more than that, because the government's running out of money and they're a higher taxing jurisdiction, right? So if you had a choice between investing your money in Brisbane or Melbourne, well, Brisbane's the momentum and the demographics are aligning, whereas Melbourne, the demographics might be favourable as more and more people move here, but the momentum is not. So at some point next year, I'll probably wish I didn't, but I'll probably run a market update. They just take forever to prepare for. So keep an eye out for that. Okay, suggestion number 2 is to add a buffer or extra margin to your investing variables, particularly if you're doing renos or development. Increase the amount of time you think it's going to take. Add extra margin to the cost in case there's a blowout. Be a little more conservative with your sale price. And just make sure everything still stacks up before you pull the trigger and go. Third suggestion is to reweight your portfolio. So across your portfolio, it's sensible to almost have, dare I say it, buckets, almost have accounts where you split between no risk, i.e. if it all turns to crap, you've at least got this money left. Defensive assets, which are your counter-cyclical assets or things like gold. Then you have low risk assets, moderate risk assets, and then your risk on capital. And your risk on capital is that high risk is your high return, but you almost have to be willing to say, I'm not expecting it to be preserved. I'm willing to risk all of it in that high risk category. Now, what percent you put and where, of course, it's entirely up to you. I gave some instruction in Money Magnet. It's just sitting up there behind me. There it is. Money Magnet. And you can read that if you want some more help in that regard. Point number 4. What I try and do to de-risk things is increase the tenant term, particularly in commercial property, and focus on quality tenants. So I ask myself, how will this tenant cope in times when things become less predictable? Are they an at-risk tenant or are they not an at-risk tenant? How much lease is there left to go? When's the market reset in case market rents go down? And what I try and do in times of trouble coming is sacrifice a little bit of my return for the certainty. So I'm willing to decrease my return if my risk can decrease by a greater margin. So therefore, I'm actually ahead. Point number 5, investing skill. You'll always make better decisions if you're a better investor. So that might be reading a book, listening to a podcast, going to a seminar, joining a webinar like this. However you need to roll, that's up to you, right? But investing skill is very, very important. I'm constantly working on my own investing skill and trying to become a better investor. And the last thing I'd say here is make sure you're building up reserves, your rainy day reserves. 2 parts to that is reconsider the way you're using debt and credit, and then ensure you have access to emergency cash reserves so that if you need money in a hurry because you come across a good buying opportunity or whatever it might be, you can take action. So this little intro into tonight's webinar finishes off with me asking these questions. Is your portfolio prepared for unpredictability? Because if it's not, if you haven't sat there and had a conscious thought about this, then let tonight's webinar be your wake-up call to say, well, hang on, how are my assets going to perform in 2025 if things are less certain? Have I got the right asset class? Have I got the right asset? Make sure you prepare if you don't have one, or review if you do have one, your strategy to make sure that you have considered what might happen if things get harder. What might happen if you need money in a hurry? What might happen if ... And then, of course, there's no point having a strategy if you don't invest congruently with it. So make sure that you then turn your strategy into action plans by executing it. And then, of course, things are going to change month to month into 2025 and beyond. So we have to be nimble enough to adapt as those conditions change, rather than fixed in stone and trying to execute a strategy which is no longer relevant. It's all reasonably evident, isn't it? But what I want to say in summing up is just be very careful, guard against withdrawal from all the bad news and world events that are going on that might cause you to believe that there's no opportunity out there. Because as I started off tonight's webinar, next year someone is going to capitalize on the deal of a lifetime. And if it's not you because you're not looking, well, why put yourself in that position? Okay, good. How are we going so far? Are we still awake? I can feel my throat being a little bit glitchy, so I'm going to keep drinking. All right, cool. Everyone's awake. Let's move on to part 2, twice the fun, and look at some real life case studies. This is my fun part of the webinar. So people say to me all the time, Steve, what do you do? If I followed you around, what do you actually do? I'm like, if you only knew, the answer is a lot, sometimes, and a little, most of the time. But I like to say to people who I meet for the first time, I'm like a professional Monopoly player. And they're like, do you play Monopoly like professionally in real life? Do you travel around the world and play Monopoly? No. What I do is I started my investing career with rentals, landing on the squares and buying them. And then I turned into 4 greenhouses and I've ended up in red hotels, i.e. I now concentrate in commercial real estate. And when people hear that, the very next question they usually ask is, oh, should I start in commercial real estate as well? And there's no reason why you couldn't. I mean, I was buying commercial real estate relatively early in my investing career. I just didn't know what I was doing. what I would say to people generally as a rule is you invest in residential real estate for growth because it's much more emotional, it's easier to add value, and you invest in commercial real estate for income. And the reason you invest in commercial real estate for income is there's the possibility that you can pass on the outgoings that you have to absorb as a residential property owner to the tenant as a commercial property owner. Really simple example, if your lease allows it in commercial real estate, you can pass the rates on to the tenant for them to pay, whereas in residential real estate, the landlord or the property owner has to pay that. So you can have the same gross rent but a different net rent between the two. And the net rent in commercial real estate is generally higher than the net rent in residential real estate, or put differently, the rental return in commercial is usually higher than the rental return in residential, because that's how it works. All right, so with that in mind, some lessons I've learned that I wish someone had have told me back when I got my investing career started. The first thing is that you need a return for the capital you put out investing. If you are investing in anything right now and you're not getting a return on that capital, ignoring risk, that'll come next, but just simply look at the return you're getting on your capital. And if that is low or no, or worse, it's negative, Houston, we've got a problem. So we want to get a return on our capital. That's not going to get you a gold star on the test. You also need a return for risk. You want a return on the capital you deploy. You want a return relative to the risk that you're taking. You want a return relative to the time that you're investing. And lastly, you want a return relative to the aggravation that you suffer by investing in the way that you choose to invest. For instance, when I got started with investing, I didn't have much capital. I didn't really understand risk and how to price risk. And I was young, so I thought I had all the time in the world. I had no idea about aggravation whatsoever. So I went to wherever I could find a positive cash flow property, which was in a place called West Wendouree, now Wendouree, commission homes, 25, 50 bucks a week, positive cash flow, not a whole lot, but still positive. But the aggravation, oh my goodness. So now I'm a little bit older and hopefully a little bit wiser. Anytime that there is an aggravating asset, I add extra return that I've got to get for ponying up for that aggravation. So return for capital and return for risk and return for time and return for aggravation. You want to make sure that you're getting a return for each of those dynamics within your investment. So real life case study number one, right? Here we go. This was the very first house that we ever bought, and this is a scanned in photo because when we bought this property, or when Dave and I bought this property back in 1999, there were no digital cameras. So it was the old-fashioned take a photo out the front. And we bought this property, if memory serves me correctly, for about 44 grand. You're thinking, oh, if only I had have bought property back in 1999 for $44,000, I wouldn't be sitting on this webinar here tonight. Or, I wish I could buy $44,000 properties today. If I could, all my problems would be solved. And that's just absolute bollocks. You've got to understand it was not easy to invest in 1999, just like it was not easy to invest today. There were people running around in 1999 saying prices are about to crash. Interest rates are about to go up to 15%. Now's a terrible time to be investing. The millennium bug is going to kill the world and we're all going to die and computers aren't going to work anymore and planes are going to fall out of the sky and blah, 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 blah. You should do nothing. The safest thing to do is do nothing. But opportunity called. Knock, knock, knock. Opportunity knocked. And so it was, all right, well, let's start building a property portfolio. Now, this property today looks like that. I went there this afternoon when I was putting the slides together. And this thing in 1999 has not seemed to have fared quite as well over the years, I would say. But this gives you an indication of the aggravation, right? But that $44,000 house that we did on a vendor finance deal, I'm thinking around 65 grand, is now worth around $280,000 on the low side, maybe early threes. And so you might be thinking, Steve, do you ever regret selling all those houses that you bought in the early days? And the answer is hell no, not even for 5 minutes. Sometimes I think I made life more difficult than it needs to be. But if you said to me, Steve, happiness looks like owning 100 houses like that one, I would say that's not what happiness looks like to me. Right now, I own 2 direct commercial properties, one in Tassie and one in Rockhampton, and they bring in, what is it, about 350,000 in net income. And I've got a ginormous, nearly $10 million investment in SOGIF because I so believe in that investment and the assets that we're buying. And I've got some other investments that we don't need to talk about here tonight, which is exciting, right? Some you guys might think I'm like richer than Kerry Packer, or Kerry Packer's dead, richer than James Packer, or I don't know. That's not the case, right? I have enough, and I'm active in philanthropy beyond enough. I'm not trying to be the richest person in the graveyard, as it was once explained to me. So do I regret selling? The answer is no. Actually, I should just say, my definition of financially free, and my definition of financially free is do what you want, when you want, with who you want, how you want, and for as long as you want. Right? And my definition of wealthy is being able to afford anything you want, but not wanting anything to make you feel fulfilled. They're my 2 definitions of financially free and wealthy. At this point in time, by the grace of God, I am both. So I am content. It's not a race for who's got the biggest bank account. That's deceptive, unhelpful, right? But coming back to the question, no, I don't regret selling. We would have had the carrying costs and the maintenance of all those properties, the aggravation, collecting the rent, the opportunity cost of what I wouldn't have been able to invest in because I would have been invested in these assets. And so I don't look at that and go, I missed out. I always ask myself the mantra of how do I make the most money in the quickest time for the least risk and the lowest aggravation. This is the same question that I ask myself almost daily when I look at assets to buy and capital to deploy. So what do I focus on today when it comes to real estate? You might be interested. Steve, after 25 years of doing this, what would you say to yourself 25 years ago about here's how you fast track your success in real estate? I'm glad you asked, because I would say, first of all, are you going to listen to anything I say? And I'll probably say yes, and I probably wouldn't have listened to any of it. Be realistic. So I asked that same question to you. Are you actually going to listen to what I've got to say? You might hear it, but will you listen to it? The first thing is, you will never be financially free if you don't invest in positive cash flow real estate, because you can't have enough net wealth on paper to live financially free. You need cash flow, recurrent cash flow, to fund your lifestyle if you ever hope to get out of the rat race. Now, you might be super uber wealthy on paper, but if you don't have any money to be able to live the lifestyle you want without having to work, then your assets are tied up in value, not cash flow. So I would say first thing is, just as it was the revelation that I had back in 1999, it's the same revelation today, is that there is nothing negative about positive cash flow. Woohoo! People say, oh, that's great, but where do you find positive cash flow? In fact, positive cash flow is very easy to find. Everyone here on this webinar, listening to the recording, has the opportunity to invest in positive cash flow if you co-partner in the fund that I run, because I buy positive cash flow property. So it's no longer a question of how do I find positive cash flow property. The question is, if I believe in positive cash flow property and you can't find any, I can't find any, why don't you invest where there is positive cash flow property? Because you can. All right, point taken. I don't just look to buy anything. I want to try and identify assets that have what I call strategic opportunity. Cash flow now, value later. I'll give you some examples in a second. I have had enough of my life in the high aggravation real estate space. And I don't need any more excitement by going and buying properties in low socioeconomic areas where you need protection to go and collect the rent. So I prefer better assets in better areas, and I'm happy to sacrifice a little bit of the return for the lower aggravation. And because I've just spoken to you about how next year is probably going to be less predictable, more unpredictable, what I want are assets where, as much as this can be done, are unpredictable proof, i.e. the tenant is creditworthy, long lease, risk mitigation strategies, good management. Thumbs up. How are we finding it so far? Are you still with me? Are you finding this interesting? Anyone? Yes, great. All right, we're still awake. Someone's playing ping pong. Please don't. Right. The last thing I do with all my assets is I spend a lot of time, because my background is in auditing and I'm a big believer that risk and return are related. I'm trying to find the assets where the return outweighs the risk by enough, where the profit of buying the asset outweighs the risk by enough of a margin to buy the asset. The upside is greater than the downside by enough of a margin to pull the trigger and buy it. And then after I buy it, I try and have these de-risk strategies so that as things go wrong, we don't just bump into them, we try and navigate around them. So where do I focus today? I do not focus on residential real estate at all. I'm not in residential real estate. There's not a lot of point asking me about residential real estate. I think residential real estate is on a trajectory to be less and less favorable for investors as tenant laws become more and more tenant favorable. And I think this trajectory is naturally going to favor tenants more and more as time goes on, because governments have more tenants than they have investors. And of course, they want to appeal to their voting base. So they're going to make it better and better for people who occupy residential properties and harder for people who own them. And I don't want to play in that space. I just don't want to participate in any game where I take the risk of owning it, but someone else has more rights than I do as an owner. I say, no deal. So I focus on commercial property. And I look for commercial property wherever possible with net leases. What is a net lease? A net lease is a lease where all the outgoings are paid by the tenant. Right? So I don't have any risk of land tax going up, rates going up, maintenance, blah, 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 blah. The only risk I have in many leases is the structural nature of the asset. If something goes wrong with the structure. I'm even working on one deal where I don't even have that risk. We won't talk about that tonight, unfortunately, because it's still cooking in the oven, but fingers crossed we can get that one over the line. So commercial property, net leases, middle market is where I like to go shopping. The $5 million to $15 million range. Why? 5 million, generally speaking, is too expensive for the mum and dads. 15 million is too cheap for the instos. So if I can do well in the middle market, 5 to 15 million in the property fund, in SOGIF, remember I'm not buying assets personally anymore, all my investing is done through SOGIF, and I can pool my money with other people and focus in the middle market, I'm finding that's where the juiciest opportunities are at the moment. REITs are starting to come back in the market, so 15 million and above is starting to become a bit more of a heated space. And the mums and dads and owner occupiers in the 5 million and below bid up those asset values, so therefore the return is lower in the 5 million subcategory. So I don't really like playing in that space. I try and identify locations where the demographics and the momentum are in our favor, strategic opportunity areas, and I love the idea of a good tenant story. Cool. With that in mind, I think we've got a couple of case studies. before we get there. How I focus, still own 2 direct property investments, prefer to invest in SOGIF, like I said. Oh, got to do some advice warnings, keep the lawyers happy, because we'll be talking about properties in SOGIF. So this information I'm about to share is of a general nature only, does not take into account your objectives, financial situation, or needs. Make sure you read the product disclosure statement issued by Plantation Capital Limited in deciding whether to acquire an interest in SOGIF. Past performance is not a reliable indicator of future performance. No earnings estimates are made. Any discussion of forecast profitability, distributions, returns, etc., they're all derived from unaudited financial projections. Such forward-looking statements are not guarantees of future performance, and they involve known and unknown risks, uncertainties, assumptions, and other important factors, many of which are beyond the control of the responsible entity, which means the responsible entity cannot and does not give any assurance that the results, performance, or achievements expressed or implied by the forward-looking statements will actually occur, and investors are cautioned not to place undue reliance on these forward-looking statements. Thanks for listening. So this is the deal in SOGIF. This was the first deal that we bought in SOGIF. This is in Rockhampton. It's on the Bruce Highway. It's on the south side of town. It came to me as an off-market deal. The agent literally rang me up and said, Steve, I've got a great deal. The rent's 200 grand. They're asking 2 million. I'll give you 5 minutes to decide if you want to buy it before I call the next person on the list. And it didn't take me 5 minutes to say, yep, I'm absolutely in. So here's a picture of what the building footprint looks like. So Gladstone Road is the Bruce Highway. That's on the right-hand side as you look at it. Interestingly, out the back there, where there's sort of a bit of a triangle shape there, that used to be a residential home that was bulldozed to create extra parking and hard stand for the business. So anyway, the dynamics of this one, 3-year lease back to Nutrien, one of the world's biggest ag companies. They're actually building their own premises elsewhere. So part of the risk of this asset is knowing that they're going to move out eventually. And therefore, we're going to have to backfill this tenant space. So we want to try and do whatever we can to make it attractive. So in 2026, when the tenant moves out, we've got an attractive site for someone else. Starting rent 200. Annual CPI increases, let's assume 3% per annum. And the purchase price, as I said, was 2 mil. So the sum of the cash flow that we're going to get over the rental period, 200, 206, 212, let's say it adds up to 616,000. In commercial real estate, it's really simple maths. We take the net operating income, which is our net rental, and divide it by the market cap rate, and that gives us the property's value. So what we can do is we can say the rent at the end of year 3 is 212, no expenses, my net operating income is 212. Now, we don't know what the market cap rate will be in 3 years' time, but if we assume it's the same as the purchase cap rate when we bought it, then 200,000 divided by 2 million is a 10 cap. So 212 divided by 10% means the building with the rental increases will probably be worth around $2.1 million. So we can then say that our future value is 2.1, our purchase price is 2, so our capital growth is going to be 120. And then we can say our cash flow was 616, our future growth is 120, so our total upside of buying this investment is around 736 grand. Now, what's the downside? Say we bought this asset and thought we'd made a giant mistake. Let's say that we took a 10% hit on our purchase price, 200 grand, $200,000 in costs, stamp duty in, agent's costs out, means that we're risking 400 grand. And so the question we have to ask ourselves as investors, does the upside outweigh the downside by enough of a margin to go ahead? Would you be willing to risk $400,000 in order to make $616,000, right? Are you willing to get a return of 1.54 times your risk? Or if you wanted to boil it down to a percentage, this is an 18% return on your at-risk capital, i.e. your 400 grand. Are you happy with an 18% return on your at-risk capital? I would have thought the answer to that is fundamentally, hell yeah, right? It's not an 18% return on the overall investment. It's a return on the amount of capital that you've actually got at risk. And because people don't understand risk and they don't understand pricing risk, they sometimes get caught up in not buying assets that they should otherwise buy. All right, hang with me. Now, as luck would have it, the property next door came up for sale. Mama's Fish and Chips, which is here on the corner. If you look at the top of the picture there, you can see where our hard stand used to end. And now if we wanted to buy Mama's Fish and Chips, we could actually increase our footprint to be the whole of that corner. Do you think, without knowing too much about it at the moment, this would be a strategic opportunity to go and buy that extra corner for extra parking, and maybe even in the future bowling over the whole building and building something else on that space? Well, there's no way in God's good earth that most real estate investment trusts would ever look at buying Mama's Fish and Chips. However, because we're looking for the strategic opportunity and we want to try and improve the value of this building, it was an absolute no-brainer that we would go and purchase Mama's Fish and Chips. It's a bit like playing Monopoly, isn't it? We own one square, and then the property next door to it comes up for sale, same color. Why wouldn't you buy it? So we did. We went and bought Mama's Fish and Chips for about 300 and something thousand. It's on a reasonably low return, somewhere in the mid sixes, but it's a strategic opportunity because it helps us increase our footprint over the whole of the land. Now, lo and behold, the agent rings me up and says, Steve, would you be interested in buying the residential property out the back of your site? So if we look at this map here, do you see what, I don't know if I can do this on this. Do you see what the buildings immediately to the left of where the other residential property was? Would you want to buy the residential property on the left to therefore increase the building's footprint to look like that? Who says yes? Who says no? Wayne says yes. Ross says yes. All right, everyone's sort of saying yes. So, once again, we roll out the Strategic Opportunities Growth and Income Fund and say, is this a strategic opportunity? And we say yes, because if we can bowl it over, and it's a big if we can bowl it over to increase the footprint, not only of the building now, but as a strategic opportunity in the future, why wouldn't we? So this is a property. I told you I don't buy residential anymore. I told a lie, obviously, because I just put this one under contract. Signed up yesterday. $320,000 is the purchase price, subject to due diligence. And of course, the due diligence is not about the yield on the property. It's will council support the property being bulldozed and us increasing our hard stand area. The other thing which works really well here is that in the future, it gives us another crossover. So if we ever needed to, if I go back, if we ever needed to put a service station here with a drive-through and we wanted that extra access into this road here, having that residential property would give us that extra driveway, which would be happy. So this isn't a rezoning exercise, it's a permitted use exercise, slightly different. So anyway, that is the latest on that deal. Is it worth sacrificing some of the deal's overall yield to future-proof the asset? Oh, I think the answer is yes. I would be happy taking a little less return, but then building up the long-term value of the fund, because if we ever needed this property and we didn't buy it now, and we had to go to someone and say, here's a blank check, write a kind number on it, it might be painful. All right, next property I've got for you. These are all owned in the fund. This one is also in Rockhampton. It's not, we don't own the dealership, but we own the land and the building that the dealership is on, and we also own the little block of land to the left that's got the cars parked on it that you can see in the picture. Here's what it looks like inside. Nice building, great service area out the back. We bought it with a 9-year lease. It's a net lease, $472,000 a year in rent. All the outgoings are paid by the tenant, and our purchase price was 7.2 mil. So when you crunch the numbers on this, you go, the rent divided by the purchase price gives you a return of 6.57%. And you're probably thinking, meh, 6.57% doesn't get me excited like 10% on the last deal. Hang in there, right? If you add up the remaining rent from when we bought it, divided by the purchase price, then 60% of our purchase price is covered from the rent we're going to get off the tenant, which means 33% of what we paid is vested in the value of the land and the buildings. So if the value of the land and the buildings is more than 33% of our purchase price, then we are squarely in the deal zone of buying value, right? So that means that our land and buildings value is really only $2.3 million. Now, do you reckon, here we go back a sec, do you reckon that for $2.3 million, you could buy this gigantic corner site and build these buildings on it to make it, well, of course the answer is no. To build that building alone would have to be somewhere around the $5 to $7 million mark. Plus you've got the land, plus you've got all the hard stand, the concreting that the cars are parked on. So this is a smashing deal because of the value that is inherent in the price, right? So now, the future value, the rent at the end of the lease will be nearly 600 grand. If we divide it by the purchase cap that we bought it on, that means it's going to be worth about 9 million. Still a great deal compared to replacement value. We take the rent, we do the capital value increase as the rent goes up, feeding to extra value. Our return 6.7 on a purchase price gives us a 93% return over the lease period, or 10.37% per annum. Who's happy now? If I could buy assets like that all day, every day, I'd be extremely ecstatic. But these kind of deals are the unicorns walking over rainbows, right? They're not everywhere. You have to look hard. You've got to kiss a lot of frogs. You've got to know what you're doing to be able to spot the value that other people don't see, the strategic opportunity. But wait, everyone, this story gets better. Mazda globally demanded that the showrooms be upgraded. And so the guys had to spend more than $1 million on the building to build this giant canopy over their service delivery area. And this brand new little coffee lounge area inside, more than $1 million they spent. And how much of that did I have to pay? Remember, we own this now. We own the building. How much? How much of that $1 million did investors in SOGIF have to pay? Anyone? Not a cent. Who else wants the tenant to spend $1 million on your building, making it better? Yes. Good. So the outcome is they improve our building at their cost. The tenant becomes stickier because they've just dropped $1 million into the building. And now we've got a justification for the value of the building going up because it's now got a giant canopy on it and $1 million of capex that it didn't have before. What other assets do we own in the fund? Really quickly, a flyby. This one in Brendale, commercial industrial. This one in Pimpama. It is what it is, a service station with some retail. The early settler down in Moona in Hobart, a beautiful corner site. Already has proposed planning to allow it to be redeveloped into apartments, which is interesting. We bought this little asset, Subaru in Narre Warren, which is probably one of the lesser performing properties in our portfolio at the moment, but I think this property will, after we do a lease renegotiation, become one of the better performing properties. Hey, we own an Officeworks. The latest purchase is this little cheapie in Emerald in Queensland outside of Rocky. It's got a car wash on it and a car dealership on it. It's an 8% return on a 5-year lease, slightly longer because the car wash is in there for 10 years. And it was just a great corner block, which would be, given the access points that you can see looking at the picture, 1, 2, 3 access points with turning lanes, that is screaming out to be a future service station. So we get income now and a strategic opportunity down the track. Service station, fast food. Now, I want to tell you about a deal which we will settle on in about a week's time. So I saw this property originally when it came up for sale in an auction, and I don't buy property at auction, so I went, damn, this would be the sort of property that I would like to buy, but it's at auction, so I won't be buying it. Well, it sold to someone at auction, and then they flaked out. These things happen. So then it came back up for private sale, and I'm like, right, I know this area really well. I drive past all these car yards on my way out to Bindi, the farm that I own. And in Traralgon, which is about 2 hours southeast of Melbourne, there is a special zoning along the highway, which is special use car yards. So basically, if you want to have a car yard in Traralgon, then it can only be in this strip of land. And you can see in this strip of land, all the car yards are there. It goes on as far as the eye can see in this picture. And so what was for sale were 2 buildings, MG and Suzuki in one building, and Jaguar and Land Rover in the other building. And here's what it looked like at a different angle. So we've got the Land Rover and the Jag, and then the Suzuki and the MG. And so when I went and saw it, I was like, I like this. I like this asset. I like it a lot. But I would like it a lot more than a lot if I could also buy the Mercedes next door dealership. And like in Monopoly, I could have 3 properties all in a row. 1, 2, 3. Oh, funnily enough, the guy who's selling the Suzuki and Jag dealerships, the buildings, the site, also owns the Mercedes. So I said, look, I'm not super interested in buying just what's for sale, but if we can also wrap up the Mercedes buildings, a Mercedes building at the same return as the other ones, then yeah, I reckon I'm a happy camper. And that is exactly what has happened. We've gone ahead. The tenant is an international tenant out of South Africa. I think they're capitalized to 2-something billion US dollars. And then our footprint is now 1, 2, 3 assets in a row. The rent's 750 rounded, the purchase price 11 million, remember, middle market. And so the return is 6.79%. The WALE's only 2 to 3 years, weighted average lease expiry. So what we're going to be trying to do is renegotiate the lease. And what I expect I'll do is I'll say, look, we'll put some money aside for CapEx redevelopment of the property in return for higher rent. And this will be the horse trading that I do behind the scenes to add value into SOGIF. And if we do the calculation really quickly, adding in the future capital growth, the cash flow only return increases to growth in cash flow 8.27%. So it met the required hurdle rate in order to take the risk. Then a funny thing happened soon thereafter. The agent rang me up and said, Steve, same strip of land, there's a bigger site available. Subaru, Mitsubishi, Mazda, Isuzu, and Volkswagen up the end there. Would you be interested in increasing your land holding in this area to include all of these assets? And this is where hopefully I'll be able to include Sharon in on the discussion. Let me see if I can find Sharon. Sharon. Oh, we've got Sharon and Sharon Webb. So I'm going to try this one first. In fact, I can try both of them. Hey, Sharon, are you there? You might have to unmute at your end, Sharon, if you can figure out how to do it. Although it says you're...
Yeah.
Oh, you're there!
I've got that.
Hooray! Hi.
Yeah. Okay, I'm I'm on a very dodgy internet connection on my mobile phone, so I apologise to everybody if you can't hear me, but I'll try and speak clearly so that you've got it. But yes, Steve, I'm here.
Okay, first question. Are you an investor in SOGIF?
Oh, yes,
All right,
big time. And
full disclosure, you're an investor in SOGIF, and are you a family friend of ours?
yes, I am.
Okay, yes and yes. So Sharon, who
Yep.
is presently living overseas with her beautiful husband Ollie, was back in Australia, and I needed some company to go down and look at this site. So I said, Sharon, do you want to hop in the car with me and we'll go and look at this asset together? And poor Sharon was hopelessly jet lagged, but she was very kind. On a very hot day last week, Sharon and I went down to have a look at this property. Now, before we talk about this property, Sharon, what were your thoughts of the earlier property, the MG, Land Rover, and Mercedes site? Anything you'd like to share with the people listening?
Oh, the quality was incredible. The buildings are, to look at them practically new. Maybe there's a lick of paint needed on the Mercedes dealership, but overall just very impressive, and it's very clear what you see when you go and visit something compared to what you can't see in a photograph, even with the best images available now, is just how busy that highway is, just how much foot traffic there is going in and out, and just the quality and size of the buildings and the footprint is really impressive.
Now, we were driving down there, and one of the discussions we had is, would buying this extra parcel of land mean that we are too invested in this area, i.e., are we overexposed by buying this extra bit? Would we be better off putting it in some other investment vehicle that's not SOGIF, or should we buy it in SOGIF? And that was what we were contemplating. So as we went and looked at the site and we met the on-site manager, Chris, over to you, Sharon, to share what was going through your mind as we looked through all these buildings.
Oh, wow. Certainly, I was extremely impressed with the buildings, the quality of the build, um, the layout. It just, obviously perfect showrooms, really very large site. What was really obvious to me, though, on the day that isn't obvious to anybody on this call and could never be, is the quality of the manager employed by the tenant. This Chris chap, just a really energetic, very productive and entrepreneurial type of a spirit that he has. The staff loved him. I think he knew the names of every single staff member that when we walked through, those staff had been there working with him or with, in that car yard between 15 and 35 years. These were solid country people who love their work, who love working for him, and he is really enthusiastic about working for this overseas company that is employed that employs him and the rest of the staff. He's made lots of improvements just internally to the buildings to maximize the usability of all of the spaces, and just a very, very impressive manager. And I kind of came away with the feeling that no matter what commercial properties we bought, I'd love for him to be the manager that's part of our tenant enterprise, because uh, for me, a lot of the about risk was removed by physically going along and seeing and speaking to him and looking at the way that he dealt with his people,
So
for sure.
question, Sharon, would you be worried about us being overexposed if we were to buy this asset in SOGIF?
Not at all, for a couple of reasons. Obviously, there's your monopoly analogy. The more that you own along that strip, the more that you control that land, and the better opportunities you've got in the future. But a couple of things stood out. You mentioned briefly before, this area has been zoned for this type of development, and no other area in the Traralgon, uh, what do you call it, the council area there, uh, has been zoned for this. This is it. So whatever's on this parcel of land can be car dealerships, and there is very little opportunity for any competitors to come in and compete with that strip of land for car dealerships. So that was really important, that we weren't going to be taken out by land being developed somewhere else for competitors to come in.
What people,
The other thing
oh,
that
you go.
yeah, sorry, the other thing I picked up was, and it was a question that I asked the agent that was with us, in fact, was aside from the hospital, which is a beautiful new building, I'd imagine that there'd be a lot of employees there. And he said there's about 450 employees at the hospital. I said, this whole car precinct now and this particular dealership itself, how many people would be employed here? And just within this dealership, there was about 176, I think he said, employees. And that started to make me think that in this regional area, these car dealerships would be perhaps second only to the local hospital in terms of the number of people they employed. So we're not likely to have local council do anything in terms of development that's going to upset this particular group because they're such a large employer in a regional area. And for me, that really brought it home. I just felt like if we don't invest in this, we're making a big mistake. And in fact, I said to Steve and the board members on the phone call on the way back, I'll put more money in the fund if you buy this, but it's not up to me. So it's over to them. Sorry, Steve.
What was really interesting is that you can't see it. To the left of this picture, there's a giant major hospital. And to the right of this
Mm.
picture is Traralgon proper. So there's a lot of traffic driving backwards and forwards. And out the back where you can see paddocks, all that is slated for future redevelopment in the West Traralgon precinct. So this is one of these areas that in the not too distant future, when I say that, I mean 20 years or so, will look, I think, a lot different to what it looks like right now. So thanks, Sharon. Great to hear from you. I
No problems.
want to make sure everyone else feels like they had sort of the same opportunity to see what Sharon saw, and there was no advantage to Sharon, no scope for insider trading or anything else like that. This is a deal that I'm working on at the moment. It's a $23.5 million purchase. So bigger bickies, but if you look at what we bought for 11, we're actually getting more land and more building at the $23.5 million mark. So fingers crossed I can pull that off. Just waiting to begin my due diligence period with that right now. I like the idea, and Paul has floated it, that we might do an investor tour in 2025 so that other people can come down and have a look at these assets. Thanks again, Sharon. So in the pipeline at the moment, I'm pretty busy. There's $67 million worth of property that I'm looking to buy. That includes a strategic truck shop on a 15-year lease and something in Western Sydney. Normally don't trust anyone from Sydney, of course, being a Victorian, but this particular property would be an off-market beauty if I can pull it off in Western Sydney. Stay tuned for more information. I was working on that this morning. Might be making a trip up to Sydney next week if anyone wants to come and have a look at it with me. Watch out. All right. So speaking of SOGIF, have we sunk or have we soared? Really quickly, again, remember this is general advice only. No earnings estimates are made. Past performance not a reliable indicator of future performance. So what is the SOGIF story? Remember, I'd done really well in the United States of America with the US fund. People were asking me what's next. People were literally crying, saying we don't know who else to trust with our money. Not making that up at all. And I was like, oh, I really don't want to do this. And they're like, but Steve, we really need you. And I'm a sucker. Anytime anyone says they really need me, I'm like, all right. So provided Paul does the heavy lifting with the compliance and the reporting, I was happy to buy the direct property. So we started a passive Aussie fund, and we weren't sure what to call it. We didn't think we could call it the Passive Income Australian Property Fund. That's a bit boring. So we ended up calling it the Strategic Opportunities Growth and Income Fund. We're looking for strategic long-term quality assets that we can look and buy and hold and simply profit from them over time. How has the fund been going? Well, compared to the same time in the US fund, we are absolutely crushing it. In the year ish since we got going, if you just look at the cumulative return, we're sitting at 5.45%. So if you add the contribution fee savings that you added in on that, plus I'm pretty sure November is going to be a bumper month given what's happened on the stock market and our efficient assets, this thing is like bolting out of the gate when it comes to funds. Now, people say, but the redemption price is sitting lower than the issue price. You've got to understand that when you buy real estate, of course, you've got costs on the way in, and the redemption price builds out sales costs as well. So the redemption price is going to trail below the issue price. But if you look at the cumulative return, if you got in when units were $1, you've now already got 5.45 cents of value delivered to you. And come back in a few weeks' time and let's look at what's happened at November. And I'm quietly confident you'll be very happy. So, what is in this SOGIF portfolio? I'm glad you asked. We've got cash that's earning interest until we deploy it of about 17 million. We've got efficient assets of 42 million. So our efficient assets are assets in the stock market, which are crushing it at the moment because the stock market's going up. So we're very exposed to doing well from that. We've got nearly 50 million already in direct property, 1.5 million in other bits and pieces. Means our total assets are sitting, or were sitting at the 30th of October at 111 million. What about our efficient asset performance? So our efficient assets are assets that we've invested into equities as part of our diversification, so we're not just a property fund. So if we look historically, and we do what we call weighted performance because we haven't got all the money in the market at the one time. So if we look at our weighted performance at 30th of June, it was 6.5%. That increased to 14.3% in July as the stock market roared back, had a bumper month, it then dipped back down again. This is not for the month, this is across the portfolio as we go. In August, it was 11.3%, 14.9% in September, and dropped back a bit in October, 13.6%, but unless something crazy happens in the next week or so, I'm pretty sure you'll see November back up higher than 13.6%. So if you look at the return of the fund and the return on the efficient assets, we have been able to benefit very much so from the increase in equity markets. On the property side of things, we own 8 properties, 10 tenants, got about $3.4 million of net income. We've got fair market value of 49.4 million, and our cap rate, so our simple income return on our properties, no growth, just our income return is sitting at about 6.8% across our portfolio. So if we do some simple maths on that inefficient assets, we have a direct property, 6.8% as a cap rate, and if we said the average rental increase across the portfolio was 3% per annum, then we're sitting at just under a 10% return on our property portfolio, which is pretty bloody good if you ask me. So what's ahead? I'm here to tell you that great things are happening in SOGIF. I am so happy that I am the biggest investor in this fund. Why? What's happening exactly? Well, those efficient assets have performed very well in November, like I said, and now our annual rental increases are starting to kick in from the properties that we bought. And so therefore, those increase in rent will feed through to an increase in fair market value, which will then feed through to the unit price into 2025. So with that in mind, there might be some of you going, damn, I wish I had got back in, or I wish I had put more in, or is it too late to invest now, or what can I do? Can I top up? I've got a little poll. Like I said, I'm not here to sell you anything tonight, right? If you want to join me in the fund and have me and my team together try to make as much money, most money, quickest time, least risk, lowest aggravation, you absolutely can. If you don't want to, I'm not going to lose any sleep over it whatsoever. If you want to join me on the opportunity, I'm happy to work as hard as I can for you as I am working for myself, right? That's the opportunity that's on offer. If you want positive cash flow, and you don't want to buy the asset in your own name because of the concentration of risk if you were to buy a $5 or $10 million asset, then this is something that I would urge you to have a good look at to see whether it's right for you. So with that in mind, I've got a little poll question here, and if you can answer this question, then I'll click launch. What happens is we can track who clicks what. So if you would like to register your interest to make a top-up investment, then just click that option. If you want to make an initial investment and you haven't got in yet and you want someone to help you talk you through about what to do, then by all means. If you want help setting up your automatic investment plan, you're already an investor in the fund and you want to start topping up each month, click that. Or alternatively, if you're not interested, you're just, hey, I wonder what Steve's been buying lately, a little sticky beak, then that's entirely fine as well. I'll give you a couple more seconds to answer. Jump on, folks, click something. Franco, I see your question. No, it's not the answer that you've put there. It is actually, it's the value increase that happens from the rental increase. So cool. All right, we've had 54% of people voted. Let's see if we can get up to 60. I'll give you 5, 4, 3, 2, 1. All right, thank you for answering. I'll close that off now. You can still get in touch with us later on. I'll explain how. In fact, there it is on your screen. It's in your slide deck. If you're watching the recording, of course, you can't participate in the poll. So just email your interest to admin@sogif.au, or if you think you want to have a go at navigating it, jump onto sogif.au and follow the links for how to invest. And that will explain some more. Wish I had more money to invest, but don't button. Sorry, Leanne. All right, part 4, Q&A. So, I'm here to answer any questions that you might have. The way that I do this is I prioritize people who want to put their hand up and say, hey, I've got a question for you, and we can talk over the internet. If not, I will try and I'll try and answer the questions that are in the question box. All right, cool. So if I come back to here, sorry, I have to do a couple of things at my end. Does anyone want to ask me a question? Click here. All right, so Dave Hamilton, you've got a question. Hello, Mr. Dave Hamilton. You are self-muted, so you have to come off mute, mate. There you are. Hi.
Hello, young fella.
Now, you get to lay claim as probably someone on this webinar who's known me the longest point of time. Full disclosure, how do we know each other?
School since mid-1980s.
1984, which by my rough maths would be 40 years ago this year.
Yeah, and we're both bald. So what's that say?
But we both used to have hair, and we can remember when. Fond memories. Now, we like to play table tennis. So that's another thing we should probably disclose. But what's your question, Hamo?
No, it's just really what sort of minimum investment?
Oh yeah,
is that something?
Yeah, I didn't really go into it tonight, but minimum investment's only 10 grand. So I tried to make it available to as many people as possible. I think the average investment is over 100 grand, but my kids are in it. They both participate in the AIP as well, because I wanted to teach them how to invest and get them involved in it. So yeah.
And what sort of time frame will the fund run for, like closing side of things and the maturity side of it, in terms of initial investments, extra investments maybe in a few years, and what's your sort of crystallization dates?
That's a good question. So unlike the US fund, we don't have an end date on this fund at this point in time. What I expect will happen, because we want to buy these assets for the long term. And when I say long term, I'm talking 20 plus years. That doesn't mean you have to be in for 20 plus years, because there are these biannual redemption opportunities. But I'm not looking at sort of having this there for 10 years and then selling everything like I did the US fund. So that would mean there needs to be some longevity beyond me, right? And that's fine. I mean, you only need me to help buy the assets. You don't really need me to help manage the assets. So I anticipate at a point in the future, I don't have, it's not next year, it's not in the next few years that I can foresee, that they'll get to the point where someone will be able to then take over what we've started and keep it going. And then at that time, you'll have an opportunity to decide whether you want to jump out or not. But there's not...
I'm not going to blow your head up, but how's there going to be a succession plan for someone as good as yourself, though? That's interesting.
Well, you only need me to buy the assets. You don't need me to do the compliance and the reporting. And once the assets are bought, it's really just set and forget. And there's a board. It's not just me. There are systems and there are processes involved. So, yeah, I mean, I obviously have a very important role to play at the moment. But I don't see this as the Steve McKnight show. It's definitely not.
Okay. I'll let some other good person ask a question. Thank you.
All right, thanks, Hamo. Always nice to chat. Steve Walton. Hi, Steve. Where are you? Oh, there you are. Sorry, Steve. I clicked off you. You're back. Do you have a question, mate? You there, Steve? Oh, no, Steve's listening. Steve's listening to TV. Patrick Ward, are you there, Patrick? You'll have to come off self-mute, mate, if you want to have a chat. There you are.
Oh, hi, Steve. Can you hear me?
Yeah, I gotcha.
Oh, you got you. Steve, when these businesses take on all the expenses of the properties, do they pay insurance?
Yes.
The like of the building?
Yes. If it's a net.
So they pay the whole lot.
Yes, that's why it's called a net lease. So they typically pay everything except structural issues. So if there's something to do with the roof that requires the roof to be replaced, or something wrong with the slab or that kind of thing, that's a structural issue. That's on the owner. But a good net lease, everything else will be on the tenant.
Right. So how do you make sure they have paid their insurance?
We typically pay it and then bill them back for it. And if they want to...
Oh, you bill them. Right. Fair enough. That explains that then. Yeah. All right.
And if they want to have their own insurance policy, we follow up with them to make sure the insurance policy is still current every year.
Oh, it's brilliant. All right. I was just unsure because we, like my wife and I do residential, and, you know, the whole lot falls onto us. So
that's where resi's different to commercial, my friend. All right. Thanks, Patrick. Good to see you online tonight. Anne, no, Anne doesn't have a question. Sue, are you there, Sue? Hello, Sue L. You are self-muted, Sue, so you'll have to click the unmute button at your end if you want to have a chat. Put your hand down, Hamo. There you are, Sue. Are you there?
Yeah.
Gotcha.
Yes.
Away you go.
So all this work that your team are doing, there must be fees involved.
Absolutely.
Is there like a percentage?
Yeah. So.
Or how do you work it out?
All I'm doing is talking about what I've bought tonight. I don't want to try and sell anything in anyone. So what I'll do is I'll encourage people, if they want to find out more, to have clicked that link or get in touch with us, and then we'll just sit down with you and explain how it all works. But
awesome.
Naturally, there are fees. I'm not asking anyone to invest tonight. I'm just asking people, if they want to know more, to let us know, and we can have a chat with you and try and answer any questions you've got. It's all outlined in the product disclosure statement. But that said, there's a whole onboarding process that we like to do with people to make sure that they've considered whether or not the investment is right for them.
Yeah, and I mean, this might not be appropriate for this, but can you invest through your super fund?
If you have a self-managed super fund, you can. But if you've got like an industry super fund, or you're part of a...
No, self-managed, yeah.
Yep, if you've got your own self-managed super fund, then provided this investment stacks up with the investing strategy, I probably should click this next slide, which I haven't. Provided your investing strategy aligns with what this investment's about, then it might be appropriate.
Okay, great. All right. Well, yeah, I'd like to talk to somebody. That would be great.
If you didn't click the link before, just drop an email to admin@sogif.au and we'll follow up. Might take us a couple of days to do it, but we absolutely will.
How will we know that the call's coming from someone from you? Or will they just leave a message and then we'll call you back?
Yeah, you could do it that way. It'll be from someone called Romy. Romy usually does the first call, but yeah, in these days of scamming, you can always say, hey, can I call you back on the office number and just reach out to you that way.
Yeah, I just don't take calls if I don't know the number, that's all.
Fair enough. Then
all right.
Yeah, I'm sure you'll be able to organise something with Romy. Thanks, Sue.
All right, thanks.
Daniel, did you have a question? Good evening to you. Self-muted, Daniel, again, if you want to say something, I'll just, there you are. Hey.
Hello, nice to see you again.
Yeah, it's been a while. You well?
Yeah, doing well. Out of a job at the moment, so because I've gone back to study, took redundancy, so this could actually suit me really well because it's really hard to get loans when you don't have a job.
Very much so.
This might be a find out details later question as well. But so it sounds like you're buying at $1. The value of the funds now at say $1.05, but redemptions say 96 cents. If you bought in now, how long are you thinking it'd be before you could exit again and be ahead?
Oh, how long's a bit of string? And that sounds like a bit of an earnings guidance, which I've got to be really careful about giving. Because as we continue to buy property and pay these stamp duty costs, we kind of get ahead, get behind, get ahead, get behind kind of thing. So what we say to people is that this is a medium to long-term investment. So you really want to be in it for at least 5 years, ideally longer, to recover back those initial purchase costs that we all pay when we buy real estate, stamp duty, etc. Otherwise, if you just get in and then trade out, you're going to cop the costs on the way in and the sales costs on the way out as if we sold the property, and it's going to be really hard to make money.
Okay,
if anyone's confused by this concept, let me tell this story really quick. If we went out and bought $1 million property today, we'd have to pay stamp duty on it, wouldn't we? Yep.
Yeah.
And then if we sold it tomorrow for $1 million, we'd have to pay sales costs on the way out. So even though we bought it for $1 million and sold it for $1 million, we'd lose money.
Yes.
And that's what we're explaining about the difference between the issue price and the redemption price. So anyone that comes in now doesn't avoid having to pay the purchase costs and the stamp duties and things like that of the assets we've already bought, because that becomes built into the issue price. So no one can sort of say, I'm going to wait a year and try and game this and come in when the assets are bought and not pay any purchase costs. Those purchase costs will sit in the issue price for as long as the asset is owned.
Sure, okay.
And then on the redemption price, if someone wants to redeem, then it's only fair that we assume that the whole portfolio is sold, and therefore there are sales costs associated with selling that property. Otherwise, people would be trying to exit before paying their share of the sales costs. So that's why the issue price is higher and the redemption price is lower at this point in time, because the issue price builds in those purchase costs and the redemption price builds in the purchase costs and the sales costs.
Okay, and you just split those purchase costs over the proportionate across the funds invested. So if one guy's put in 100 and the next guy's put in 1,000, he pays 10 times as much the purchase costs and so on.
Kind of. It's all implicit in the unit price. So everyone pays the same unit price, but if you buy more units, then arguably you're paying more of a cost, but then you're getting greater ownership of the asset. So of course it makes sense.
Sure, cool. Thank you.
Yeah, pleasure. Good to hear you again, mate. All right, Sue, we've had a chat to. Daniel, we've had a chat to. Jad, you're next. Good evening to you. Remember to come off self-mute, which you've done. Hi.
Hi, Steve. Yeah, just wanted to say thanks very much for everything you've given to the community over the many decades of sharing your talent and hard work with us. My Christmas present to myself this year is actually going to be the STEPS program that you're offering. So looking forward to continuing my real estate journey with some more specialised education thanks to you.
That's awesome.
My question is regarding, if memory serves me correct, with your US fund, one of the major advantages with that was the investors really got taken along for the ride and got a lot of insight into, I guess, the strategies behind your purchases and the inner workings of how you went about it. And I was just wondering if investors were going to get that same level of insight this time around.
Absolutely. Tonight was only going to be for investors in SOGIF. And I thought, you know what, it's been a while since I've done a PropertyInvesting.com webinar, so why don't I kill two birds with the one stone? So I do webinar updates for SOGIF usually every quarter or thereabouts, or more often if I've got something special to talk about. So yeah, it's absolutely, I treat you like an investing partner, sharing information and insights along the way.
That's great, thank you.
Happy days, much like we've done tonight. All right, Patrick, I'll give you another go if you happen to be there. Are you there, Patrick? You still there? Oh, I might have not put your hand down from before, Patrick. I think we're all good. All right, some questions that have come in the screen. Sylvia, my daughter's now married. I got you to sign that book for. I was interested in the commercial property, but couldn't get to your show you put on in Melbourne. Is there anything I can read or watch? Sylvia, that commercial property seminar will be available for sale on PropertyInvesting.com in 2025. What you guys don't know is that I've started a big rebuild of PropertyInvesting.com behind the scenes. It's very early days. The new website's going to include a Steve chatbot, which will be a language module of some of the resources that I've written. It's got a really good calculator called Deal Detective. And the commercial property seminar will be available for sale. So if you can just wait until next year, you will be able to buy it then. Thanks for your questions. How often are dividends distributions made? Asked Russell. They're each quarter. Are there any exit fees when I sell out of the fund? No, there are no exit fees. Timeline of the site. Do you mean PropertyInvesting.com? Elizabeth, you might just have to give me more information there. Will there be a limit to the size of the fund? James D wants to ask. No, Jimmy D, there won't be. Time frame of the site in Emerald to develop. I reckon longer than 10 years, Elizabeth, because the car wash lease there has got around 10 years to run. I was wondering what you meant by aggravation, Delilah asks. Do you mean trouble, difficulty involved? Yeah, just the anxiety of dealing with people and collecting rent and they don't pay the rent and maintenance and toilets not flushing and the general aggravation associated with the investment. Jane wants to know what's the STEPS program. Go to PropertyInvesting.com, Jane, but it's basically my due diligence program that I run through before I buy property. Brucey wants to know, do we get a structural engineers report? Yes, Bruce. In almost all cases, we get what's called a TDD report. CBRE normally do it for us. Costs about 10 grand. But yep, we get a thorough technical due diligence report. Can you withdraw your investment at any time? No, we usually do 2 redemption opportunities a year. You can transfer your units to anyone else at any time, but outside of those 2 investment opportunities, 2 withdrawal opportunities, which will begin in 2025, Paul, there's no opportunity to sell. So you have to manage the liquidity of the investment. How reliant is the fund on the return on the equities? Well, I mean, we've got 40 million bucks invested, so somewhat reliant, but the fund is definitely designed to be more direct real estate. It's just that there's a time frame involved in being able to deploy that money and buy that real estate, Russell. Rich, how has becoming a Christian affected the way in which you invest? That's an interesting question. I would definitely say I pray a lot for wisdom and discernment. I was praying about that about a property deal we're looking at buying today. And just, I think, accountability and honesty in the way the fund is managed. I would never say to someone that it's a Christian fund. I always find that anytime someone has to come out and say they're a Christian, so therefore trust me, it's probably something I wouldn't trust them on. But certainly I keep praying against temptation. I want to do a good job with people's money. I mean, I said to the guys in the office the other week, I said, look, if you want a mission statement for what we're trying to do, we want to be good at managing other people's money. That's ultimately why we exist. We exist because we want to be really good at managing other people's money. And so what does that look like? Well, that looks like trust and reporting and accountability and disclosure. Obviously, the asset selection, the way the assets are managed. When something goes wrong, we own it. We're transparent about it. We let people know about it so that, yeah, this isn't all going to be beer and Skittles at every step along the way. There's going to be things that go wrong from time to time, as there was for the US fund. But it's the question of how you cope when things go wrong that determines your investing ability ultimately. Everyone can make money in a good market, but you need skill to outperform when things are going bad. But it's usually in those bad markets where you can make a lot of money. All right. Are there any annual fees? Andy, I haven't gone into the fees tonight just because there's only a limited amount of time. If you register your interest, will be able to walk you through what the fees are and answer any questions that you've got. So just register your interest there. Daniel, could somebody potentially sell after only 1 year and to someone else already in SOGIF and not lose out? Possibly, Daniel, but we don't create a market like that. So you would have to find them and do a transfer with them. But remember, if you're investing timeframes less than 5 years, then I would probably suggest this is not the investment for you, because the timeline is 5 years or longer, medium to long term. Hello, Michael Ferguson. Long time no see. Will SOGIF have a dividend investment scheme? Yes, we've got a DRP set up so that your distributions can be automatically reinvested back into extra units. You get a slight discount if you do that. Is there a limit to how many times you can top up, Karen? No, you can top up as often as you want. With high inflation, do you see the long-term value growth to be higher? Not sure what you're asking, Franco. Remember that most leases has fixed interest, fixed rental increases or CPI. So we're somewhat insulated against CPI in the lease structure that we have. David P, hello. Just going through. What's the minimum contribution? 10 grand. Is the fund leveraged? There's no leverage at the moment, but we're looking at leveraging some of the properties up to 50% LVR, but we won't ever leverage the efficient assets because that's our capital pool to be able to draw down on in case we ever need any money. Yes, there's a recording which I'll send you later on. I'll talk about Trump in a second. We're in Western Sydney. I'm not going to disclose that, mate. Oh, you'll have stitches in your leg, but you might be interested in joining me. If it comes off, Dave, I'll let you know for sure. I'll give you a ring. Absolutely will. All right, that looks like it's just about all the questions, which is about good timing. Yep, I saw your message there too, Dean. I don't want a whole posse of people, but let's wait and see what happens, hey? Minimum top up, minimum investment's 1 grand, Steve, and top up is, I think, $1,000 thereafter. Where do you put the cash? It just sits in a bank account earning interest, Sue. All right, let me finish off because I've talked about as much as I can talk tonight and I'm keen to wrap up. Remember, if you are someone who wants to know more information about SOGIF, drop us an email, admin@sogif.au, or there's a giant website that goes through all the questions you've been asking me tonight. You can jump on it and have a look as well. That is at simply www.sogif.au. Right, last thing I've got for you tonight is what do I think? I'll rub the crystal ball. What do I think's ahead for 2025? Oh, last thing I should say is if you're wondering, Steve, do you have any of your own money invested in the fund? The answer is absolutely. I am the fund's biggest investor by a giant margin. So I'm totally invested in trying to make this work for you because I'm totally invested in trying to make it work for me. So what's ahead for 2025? First of all, we're going to have an election in Australia. And my thoughts are the budget position is deteriorating so quickly that they're going to have the election before the budget. I expect the budget will be delayed till after the election to hide the bad news. So don't be a sucker for the empty election bribe about, oh, we're going to give you this and we're going to give you that, when really whichever party's elected is going to have less money than they think to execute on their election promises. So of course people are running around trying to buy your vote, but don't be a sucker for that is what I'm trying to say. I believe Labor will be returned, but that will be with a minority government, a deal done with independents and all Greens. So what does that mean? It means that there's going to be less and less and less landlord rights, which then, of course, as I said, means more and more and more aggravation when it comes to residential real estate. So if it was me and I was looking at residential real estate, I would need the return to be higher to compensate me for that extra aggravation I think I'm going to suffer as the laws change to be more tenant friendly. Okay, second prediction. When it comes to interest rates, I think they're going to go down in February, March, maybe both next year. I don't think we'll have an interest rate fall until then. Noting that inflation today came out a little on the softish side, but not low enough to really get us excited about an interest rate cut yet. Interest rates will go down because the economy will be contracting, i.e. it'll be coming off the boil, and the government's probably going to blame it on Trump and whatever Trump does, but whatever's happening now in the economy is a reflection of the policies that existed a year ago. There's a lag effect, so hopefully we won't be that dumb. I think as interest rates go down, there'll be more and more interest attention on commercial real estate, much like there was when interest rates were lower before, and that'll lead to yield compression, i.e. it means the returns on commercial real estate will go down because people will bid up the prices and the rents won't go up by as much, which will mean, in hindsight, that the assets that we've bought in SOGIF already will look like pretty astute buying. The values that we got them for, I expect as interest rates start going down, we'll see more and more capital appreciation in the portfolio. In regards to Trump, the only thing you can say when it comes to Trump is expect the unexpected. He will unashamedly retrade deals that have been done, whether it's with Ukraine or anyone else, Canada, Mexico. It's like, you know what? I don't care. So it's going to be a bit of a wild time. He seems hell-bent on tariffs, much like when I went to university and they talked about printing money leads to inflation, which quantitative easing eventually did. Tariffs lead to inflation. And tariffs are generally accepted as terrible policy, but for some reason Trump likes them. So I expect that he will go down the tariff road, but that will lead to unintended consequences on the downside. An increase in global uncertainty, and of course nefarious global powers will test the limits of what they're able to get away with and see how the world responds, particularly with Trump not wanting to commit American troops here, there, and everywhere. Might be a bit unstable. As far as technology goes, I think there's going to be massive, giant, huge advances in AI as the exponential increase in technology on the AI curve kicks in. I think electronic vehicles will be cheaper, but they'll be less popular. There was a study done recently that 65% of people who own electric vehicles wouldn't buy another one, which I thought was fascinating. Scams, particularly online scams, will become more prevalent and harder to detect with AI. I was watching one last night of Sylvester Stallone talking about, we'll call them male performance pills. And I was like, how on earth did they get Sylvester Stallone to do this? And then I'm like, hello, McKnight, it's a complete fake. And then, of course, Einstein will be cloned, but I'm only kidding. All right, that brings us to an end of tonight's webinar. Thank you very, very much for joining me. It's been a pleasure. I can't believe I've been doing this for 20 years or so, and I've got all this experience to share and all this knowledge to share. The problem is I'm so busy in SOGIF buying these assets and setting us up for success that I just don't have hours and hours and days of time to run more and more of these events. But let's see what 2025 brings. Perhaps there'll be more opportunity to do events such as this, in which case I'll look forward to seeing more of you then. The last thing I need to say or want to say is just I wish everyone obviously a very Merry Christmas, a very, very Happy New Year, a safe, a peaceful family time as you come together to enjoy each other's company. And as we say that, I just invite you to pray with me. So Lord, thank you for tonight's webinar. We pray for that wisdom and discernment to know a good investment from a bad investment. And for those people who are interested in investing in SOGIF or finding out more about SOGIF, Lord, we pray that they're able to do that and that an answer becomes clear to them about whether or not it's the right thing for them to pursue. Until we meet up again, look after us, good health, happy times with family, happy Christmas, happy New Year. In Jesus' name, amen. Well, thank you for joining me. God bless you. I will see you on the next time. And if you are investing in SOGIF, I will be in touch soon with what I hope is some good news about the properties that we're acquiring. Until then, goodbye, good night, God bless.